Everybody, welcome back to the Loan Doctor Podcast. My name is Sean Chalice, and I'm your host today. And I'm actually what I call a recovering realtor. So for 25 years, I worked on the real estate side. I helped about 2,000 people buy, sell, invest in homes. And now for about the past 4 years, I've actually moved my services to the mortgage industry, where I'm actually a top producing loan officer at the fifth largest bank. I specialize in high net worth individuals, specifically doctors, lawyers, accountants, and I also, and believe it or not, I do a tremendous amount of VA stuff for our veterans because one, I'm a veteran, and two, I just think it's the right thing to do. They've served our country and they deserve it. So here's an interesting experience. So all of our podcasts, by the way, typically the content comes from my daily conversations with some of my customers and people just like yourself out there who are asking questions. So here was the question that I got. Two young doctors work at the VA. One is actually finished their residency. The other one is just finishing up their medical degree, and now they're going to start their residency at the VA. Also, a big shout out to Dr. H's mom, who is a nurse practitioner at the VA. So, out of all those people working at the VA, do we qualify for VA loan, Sean? And the answer is no, because you're not a veteran. In order to qualify for a veteran loan, which is a zero down guaranteed loan offered by the government, you need to actually have served in the military active duty, or you need to have been a reserve for more than 6 years. You could also be in the Coast Guard for more than 6 years, I believe it is too. And if you serve with them, you can also qualify for that loan. So let's go back to what they do qualify for and how can we help them? Because they're out there they moved out to California, they're going to work at the VA, and now they're thinking about starting a family. They want to buy their own home. They want to move out of mom's house. What I said to them is, even though you don't qualify for a VA loan with no money down, you do qualify for the physician loan with our bank. It's 10% down. I said, here's the thing about loans and mortgages. The higher the risk, the more the loan is going to cost. And with us, we've actually figured out that somebody in our back office figured out that at 10% down, we don't have to charge the borrower an additional coverage to cover the risk. So we're going to charge them a typical rate as opposed to jacking up that rate, where if we did charge 10%, unlike some companies where they're doing zero down for a medical loan or a physician loan, the challenge is with that bank has to take on a tremendous amount of risk because they're doing zero down and they're also doing no PMI insurance. So they're responsible. I could just guarantee you that the price of that loan is going to be substantially higher because they're going to pass on that risk to you as the borrower. And even though they're saying to you, hey, it's no money down, there's going to be there's going to be a tremendous amount of added cost in that loan that you may not see, or we can actually point it out for you if we were able to show you a side-by-side comparison. And what we did in this case was not only did we compare it to another company's physician loan, but we also compared it to the builder's offer because they were going to buy a new construction home. The challenge was in this case, yeah, they were going to buy down the interest rate, but the actual cost of that loan that they were going to charge the borrower is anywhere between $15,000 to $20,000. No surprise, it was the same $15,000 or $20,000 that the builder was going to give them to help them to buy down the rate. So, in essence, they really weren't giving them anything. They were financing that additional cost to buy down their own interest rate. When they came to us, we actually said, hey, even though you're not eligible for the VA loan, you are eligible for the physician loan, which we're going to be able to do with 10% down, no PMI insurance. And what is PMI insurance? So PMI insurance is private mortgage insurance, and that's to guard the financial institution, if you will, from the gap between the 10% down and the 20% down. And what is the big deal about 20% down? 20% down, a financial institution can actually take that loan and sell it to Fannie, Freddie, and or AKA the government, and it's insured by the government. And if you don't have that 20% down, they're going to require that the bank takes on the risk of that extra 10% in that gap. And then, by the way, the bank is going to take on the risk. Even though we're taking on the risk, we're going to charge you for that risk. With the physician loan, we understand that, hey, in the beginning, you don't have a lot of money. You're spending a tremendous amount of money to go to medical school. You have high debt to income. We're going to take that all into account, and we're going to still give you a better deal because ultimately, in the long run, we realize that you're a safe bet, with the likelihood that your income is most likely going to increase over time. In addition to that, typically high net worth individuals are a little bit of a better credit risk and they're better depositors. And working at a depository bank where we're licensed in all 50 states, it's important you're being a depositor as it is to giving you a loan. In most cases, we're almost doing those loans at zero cost because we're looking to get depositors into our bank, especially high net worth depositors. One of the things that we talked about with Dr. H and Dr. D is the builder was offering them a fixed rate mortgage with 3% with 30-year fixed rate mortgage, but they were going to buy down their interest rate artificially for 2 years. So what that means is they were going to actually, the first year, if that rate was supposed to be 7%, in the first year would be 2% less, which would have been 5%. And in year two, it goes to 6%. In year three, it goes to actually 7%, which actually gets a little more expensive. And what's interesting, in order for the luxury of doing that, they were charging them almost $15,000 to $20,000 that they were going to build into the cost of the loan. And what's interesting is what they didn't disclose to them was, in essence, what they were really doing was financing the cost of buying down that rate artificially in the length of the loan, and they were going to pay for that luxury over a 30-year period. And we actually gave them a different option, which is what I said to them is, hey, we can offer you a 7-1 arm, which means that it's fixed for 7 years. And at year seven, and again, I'm going to say this twice, you do not want to be in that loan in year seven. You do not want to be in that loan when it matures in year seven. So why would I give you that loan? First of all, Dr. H was actually just finishing up his medical degree, and now he was going to do his residence for 3 years at the VA hospital where this house is that they're purchasing. So the conversation became, hey, do we rent that house or do we buy that house? Because we're only going to be there for 3 years. And I said, what if I could show you the best of both worlds? And they said, what do you mean by that, Sean? Dr. H actually talked to his financial planner, and the financial planner said, hey, ironically enough, if you're only going to be there for 3 years, maybe you want to rent because the cost of carrying the home, if you're going to be there for less than 8 years, may not make sense. And I said, well, that's interesting because in my experience, and I don't have an MBA and I don't have a doctorate degree, but I'm pretty good in math and I'm pretty good at real estate because I've been doing it for 25 years. I believe in the American dream. And what is the American dream? The American dream is that you can actually buy a home in the United States, and Uncle Sam, you could either partner with Uncle Sam or you can pay Uncle Sam. So as a physician and two young physicians, you actually start to make a tremendous amount of money and you start to pay a lot of taxes. What if I could show you how to offset your taxes and also buy a place instead of renting? See, when you rent, and what I explained this to the physicians was, hey, we're going to pay $2,600 a month for the next 3 years. That's $93,600 over the next 3 years. The challenge is, and they're both smart people, and I said, hey, how much is $93,600 times zero? That's how much equity you're building in that house when you're paying somebody else's rent. When you purchase a home, the American dream is that Uncle Sam is going to let you write off all the money you pay toward interest on the loan. And by the way, the bank, typically when we give you a mortgage, the first 3 to 5 years, we want our money back first. So the vast majority of the payment is the interest on the loan. So almost all that payment becomes deductible. And then what about the taxes, Sean? Up to $10,000 are deductible on the taxes. So in essence, let's say for argument's sake, we took $70,000 which is the 10% that they would need to put down on this house, and they put it in the stock market and they got an average of 6%. Okay. That's 83,500. And that means the gain on that is going to be about 13.5. They're going to get for $70,000 that they put in the stock market, they're going to get about 13,500 over that period of time. If they buy a home, they put 800 for $800,000. Okay. And they put 80,000 down. It appreciates 6.2% a year on average. By the way, real estate over the past 100 years, outside of two times, has always appreciated. And what's interesting, the average appreciation has been like 5%. If you take out of the equation the two times, what were they? The Great Depression and then the 2008 and 2009 financial debacle in the United States. But outside of that, the real estate market has gone up about an average of 5.5% year over year. In this case, in this market, that house is actually going to appreciate, has been appreciating, I should say. For the past 3 years, it's been going up more than 6% a year. So let's just say 6.2% on average. Over the next 3 years, that house is now worth, the principal that they paid into it is going to be 30,000. Their net, okay, after it's all said and done, after they sold the house, it's going to be $130,000 versus $13,500 on the same investment. Help me to understand why you wouldn't do that and why you wouldn't take that tax break. At the end of the day, you're living in your asset. You have to live somewhere. You get an actual Uncle Sam is giving you if you're at a 35 or 38% tax break and they're giving you 100% write off on all the money paid toward interest on a loan and all the money you pay on taxes up to $10,000, that's a huge return on your investment. I don't know any other place on the planet where you can get a 35 to 38% return after taxes. So here's the best part. If you prevent, let's say the potential is you continue to rent, you're paying somebody else's mortgage at the end of 3 years, you leave that location, you still need to take money out of your bank account and now go and either buy a place or rent a place. In this case, you're going to buy that place. You're going to put 10% down. Let's say it's $80,000. If you have to sell the house in the next 3 years, you're going to have $130,000. Let's say you didn't want to sell it. Let's say you kept it because you're a physician and you're more than likely going to start to earn some bigger money over the next 3 years. Do you believe that somebody else in that neighborhood is going to want to rent that place? More than likely, yes, especially because it's only 3 years old. More than likely, that house appreciated. Worst case scenario, if you don't have the money to put down on the new house, we can pull the equity from this house. As long as we can get 80% of the value of that home, we can take the equity out of that house and roll it into the new house when you transfer to your new location, and you can continue to rent the house that you purchased. So at the end of the day, you have two choices. You either pay rent and get zero tax, and it's really what I call spending money on rent or investing money on purchasing a home. So here's one of the things too is the next thing that came into the conversation was the upgrades. And the mom was saying, hey, don't skimp on the kitchen. Just, you know what, just put everything, anything anything you can upgrade now, do it now. Don't do it after. When the two young doctors said, do we do it out of pocket? We have some cash if we only got to put 10% down. And I said, no. I said, roll it into the mortgage, whatever you can roll in. And they said, well, why would we do that? And specifically on this house, they were talking about the upgrades in the kitchen, the upgrades on the handrails on the stairs, some of the carpeting, some of the flooring they wanted to upgrade, the appliances in the kitchen they wanted to upgrade. One of the other things is the solar panels. In this house, a particular builder offered a solar package where they said, hey, you could either buy this package or you can lease the solar panels. The cost to buy them was about $8,000 or $9,000. And when I was talking to the young doctor, and she said, why, Dr. D, she said, why are you so hell bent on rolling it into the mortgage and why should we just do it now? And I said, here's the catch. I said, two schools of thought. You take all the upgrades and you put them into the mortgage on the home. Remember what I said? You get to write off up to 35% of all the money you pay toward interest on a loan and all the money you pay toward your taxes. If you use your credit card to use cash and you buy a $10,000 upgrade, you're paying $10,000 dollar for dollar. There's no deduction, no nothing there. Okay. An accountant may say, okay, maybe we can depreciate some of that. But the reality is, or a capital expense, but the reality is that your tax deduction is far better off as it being rolled into the mortgage because now what happens is if you roll $10,000 into the mortgage, that payment, that 10,000 is spread out over 30 years, first of all. And then on top of that, you're actually, even though you're paying the interest on the money, you're also getting a 35% tax rate on it. So first of all, if you do it with your credit card, your interest rate is probably going to be between 18 to 23% right now. If you finance it through your mortgage, it's closer to 6%. If you do it on your credit card, it's zero tax benefit. If you do it in the mortgage, you get the 35% tax write-off for all the money you paid toward interest on a loan, all the money you paid toward taxes up to $10,000, which means that in those first 3 to 5 years, which is they're only there for three probably, they're going to actually get the full write-off on that. Really what we're starting to see here is it's a shift from spending money to investing money. And even when we talked with Dr. H's mom and she said, hey, we have some extra money we were going to gift them. Does it make sense for us to put 20% down? And I said, no. I said, because let's say for argument's sake, you buy a house for $1 million and I put 200,000 down and you put 100,000 down because you're a physician, you have no PMI insurance. So we basically have the same payment, but you invested $100,000 less than I did. That house goes up $100,000. You actually doubled your money. I only made 50% of my money because I had to actually invest $200,000 to get 20% down to no PMI. Because you have the benefit of putting 10% down with no PMI and we get the same interest rate and we have the same payment on everything else, you stand to make far more money in a better investment because you have that extra 10% that you didn't have to put into the property. Here's the even trickier thing is if you get really good at it and you come to a company like ours, we'll actually give you a benefit for taking that additional 10%. Let's say if you put in our company or a bank, if you put a up to $100,000 or more, up to 250, we'll actually give you a certain percentage to help buy down your interest rate. If you put between 250 and 500 into our investment bank and what we call wealth management, we'll actually give you up to a quarter of a point. And if you go to 500 to, I believe it's a million, we're going to give you 3/8 of a point. When you start looking at different programs, not all programs are the same. And what I'd like to say is this, is that when you talk to a mortgage loan expert and whether they're a broker or a banker, Couple of questions you want to ask yourself is, are they just giving me a loan with a rate? Did they even look at the x-ray? Or are they trying to give me a strategy to get the lowest possible payment with the least amount of fees and the highest credits from the financial institution for doing business with them? I'm the latter of the two. I pride myself on having over 30 years of experience. My team, nobody on my team has less than 15, 20 years in the business. So you're getting a tremendous amount of resources outside of getting you some of the lowest pricing in the country and some of the highest credits. Not only that, we're giving you 30 years of experience and knowledge and support. And what's interesting is I had a physician say to me the other day, they said, if I do an adjustable mortgage and I get busy, what happens if I forget? And I said, Doc, here's the good news. When you're working with Sean Childs, you don't have to worry about that. First of all, I can't retire for another 10 years. I have two kids that got to go to college. I go over the years, I made a living on following up with people and not just giving them a loan, but giving them great service. And I have people that I've talked to for 25 years, every 90 days for 25 years. And I still do that. And what's interesting was when you're doing your loan with me, we're going to talk to you once a week just to keep you up to date. And why are we doing once a week, Sean? Oh my God, that seems a little obsessive. It's not when you think about it, because when you think about getting a loan, first of all, getting married, getting divorced, having a child, and buying a home, or I'm sorry, public speaking are the most stressful things on the planet, according to Harvard. What comes right behind that is buying a home. So if I can help you make your real estate purchase and the mortgage process as stressless as possible, you'd be far better suited that way. And then in addition to that, once we actually close on your loans, we're going to follow up you every week and we'll say, hey, we're on our way to a smooth and flawless closing, or I need this, or I need that from you. Don't worry, we got you. You're in good hands. Once we fund that loan, in the first month, I'm going to call you, remind you, hey, by the way, don't forget to make your mortgage payment. After that, I'm going to follow up you about every 90 days. I'm going to say, hey, Doc, how's your golf? How's your pickleball? How's it going? How's the kids? How's the family? Are you traveling? Hey, how's your business going? By the way, is there anything changing in your life where we need to either look at taking out some equity out of your home, maybe a possible refinance? Let's look at the interest rates. Or I'm going to say to you, hey, Doc, I could save you some money by refinancing this property. Let me give you some quotes and see what it looks like. So either one of those situations, I'm going to follow up you on a regular basis. We're not just slinging loans. We're in here for life. We believe that, or I believe personally, real estate is not sticks and bricks. Real estate is about building one's legacy. I want to help you build your legacy, and I want to help you do it as stressless as possible and actually do it with the best strategy, not just give you a loan, but I want to give you a loan strategy. It's going to work for you and your family. Dr. H and Dr. D. Hey, we're actually working at the VA, but we can't get a VA. Okay, fine. We're going to look at either giving you a physician loan. Maybe we'll look at some other loans. Maybe there's a better option if you put a little more money down, or let's look at the physician. We ended up with the physician loan at a 7-1 arm. And why is 7-1 arm? H is going to finish his residency at the end of 3 years. More than likely, he's going to take a position. He may stay where he is, or he may get relocated. In either case, at the end of that 3 years, I'll have talked to them every 90 days for 3 years, which is going to be 12 times. So we're going to know in advance if we're going to be refinancing that property, if they're going to keep it, if they're going to pull some equity out of it, or we're going to be looking to purchase a new home. But in any event, that's a strategy. That's not just, hey, Mr. Jones, here's your rate and here's your loan. Have a great day. We'll talk to you later. In my opinion, that's like doing malpractice. And where I hear people quoting rates, they don't even know what the house is. They don't know what their credit profile looks like. They don't know what they're trying to accomplish. And they're slinging rates and they're slinging loans to somebody without looking at an x-ray. Hey, my name is Sean Childs. I'm a top producing loan officer at the fifth largest bank in the United States. I joke about being a recovering realtor, but I have helped over 2,000 people buy, sell, or invest in a home over the past 25 years. If you're thinking of buying, selling, investing, refinancing, you're looking to do something with the equity in your home, you're looking to leverage your asset, and you want to learn more, you just want to have a conversation with me and figure out some options, I'm more than happy to do that. I'm probably the easiest guy on the planet to find. My actual personal cell phone is 973-461-6955. Please subscribe to the podcast. And by the way, tell your friends and Dr. H's mom for working at the VA as a veteran. It is truly appreciated, and we do honor you, and we do thank you. Have a great day.